Hi, it's Chad Larson with MLD Wealth, with MLD Money Matters for the month of December. Interesting. I waited a little bit into the kind of the mid part of the month. It's kind of stitching together as lots of activity is going on with respect to tax loss selling, tax optimization. For domiciled Canadian clients, there's some new rules coming out with respect to alternative minimum tax, and we've been busy in the background just making sure that we're all optimized into the end of the year. But what a month in November. Um, Back to kind of more volatile parts of the year, where in wholesalers and fund companies start flashing advisors like myself commentary around the importance of staying invested in the market and how fast things can change. And I think we've all seen the charts of what money looks like long term when you miss the one or two best months of a year or within a segment. November was one of those. We saw broader indices up over 5%. Money was made. Now, that year-end rally, we feel is a little front-loaded. So we had an incredible November, made up for very choppiness through the front half of the year. But the rising unemployment rate counters kind of the economic soft landing that people are starting to feel more confident about. Listen, we're going to wake up January 1st largely with a headache, and instantly be able to start talking about 2025 numbers, and the markets are a forward-looking vehicle. I kept trying to make the analogy. Baseball's been topical lately with a new big contract coming into the MLB, largest in history. But this feels very much like the back half of the seventh inning of this kind of 2 years of very choppy markets. That being said, the rally was so strong that we saw in November that we are creating a little bit of liquidity. I think the Conference Board employment trends, they reinforce this recession call. But remember, market bottoms are made in this time period and fix themselves very quickly. What we're looking for to become more fundamentally constructive, we're going to try identify these rallies, and we had capital working last month, but we're still in the cautious camp until there's really a tone change from the Fed, and that can lead to a sustainable improvement in the outlook for money. The Fed holding rates steady is only good enough when conditions are right for a rally, and we had them. So we had the biggest S&P weekly rally since kind of late 2022, and that's no longer the case. To create a new sustainable bull market, the Fed needs to stimulate growth, and that's going to be a drop in the U.S. Treasury yield. Corporate credit will become more available. Mortgage rates will come down. And typically that comes with a market event or a sharp weakening in economic data or some combination of the two. We've been calling this for months. Probably will play out in Canada much sooner. I think the Canadian homeowner is in a far more precarious place. So while I've been kind of consistent in the messaging that we expect economic data to dominate the news, they call it the newspaper headlines, that sets up the equity market and the bond market up for robust gains. So kind of grinding into the end of the year here, making sure everything's buttoned up nice and tightly. What are some of the key areas of focus as discussed over the last months? Gold is looking really interesting. We've seen a big feverish run on Bitcoin again. That's not of relevance to this conversation, but you're starting to see risk assets catch a bid. As we know, this entire market this year has been dominated by 7 stocks. The tech fangs and Nvidias and Teslas, etc. They still remain fundamentally a part of portfolios, but I think it is far less likely that they dominate like they did again last year. So the tilt to have more of an equal weighted approach to the S&P and having our capital spread more diverse across the broader industries that will benefit from the eventual easing of money supply and the decrease in interest rates. So I think credit is going to continue to be this bygone era of outsized returns relative to the risks that we're seeing. We're seeing gold setting itself up really likely. We're talking about large cap producers with strong balance sheets, dividends. The oil trade is not going well right now. We've seen a voluntary OPEC, leading by Russia and Kuwait, wanting to tilt OPEC to be more voluntary. The other members not stepping up in that regard. And so there is seeing demand destruction. Now, all of those things being held equal, long term, the lack of investment post an era of ESG and lack of kind of commitment to replacing long-term reserves, I do believe we're in a long-term tight oil supply, but in the short term, we see weakening demand, which is good, causing the price of oil to come down. So not reacting over the short term. I think this is kind of short, medium term lived in the balance sheets and free cash flow profiles of that segment, but seeing some drawdown in that sector. So we're going to see, trying to avoid certain sectors like consumer discretionary, and pivoting our assets more into counter-cyclical asset classes, such as utilities, infrastructure, that will start to benefit as we start to see benchmark and headline interest rates come down into. I'm not going to take a ton of time this week. I think from a principles basis, as we all kind of get ready to embark on a new year and make new promises to ourselves and make new things, I just wanted to kind of just let everyone know it continues to be an absolute pleasure to work with our core clients, and look forward to more interactions and successes in the year ahead. I'm available here to support you, and any questions that you might have for myself or the broader team, feel free to reach out. And I look forward to a big kind of download and outlook in January. I'm here all throughout the holidays, so anyone around, I'm around. And stay warm and stay safe, and all the best to you and your loved ones. Have a wonderful day.